economist Conrad DeQuadros says double dip would actually be disastrous since we haven't made up for the last economic slowdown. Well, Conrad is a founding partner and senior economist at RDQ Economics. Joins us in the studio now, of course, as Erik was saying, John Kanas, good enough to stick around as well. So, I mean, what do you think? What will it take for us to go from a soft patch, sluggish growth into something more ominous?
Well, you know, obviously there has been a lot of increased talk about recession. I think that that's being driven by some of the recent GDP numbers. And GDP is actually a pretty poor real-time indicator of the economy. Look back to this time last year, we'd just come off the second quarter for 2010, 1.5% real GDP growth. People talked about the potential for us going back into recession. Well, now that's been revised to 3.8%. If we had had that reading back then, I don't think there would have been any talk of recession. In the first quarter of this year, we had less than 0.5% real GDP growth. None of the other economic indicators are that weak, but it's again driving this concerns about recession. I'm not seeing it in the economic data, but I don't see the drivers of a more robust recovery in the second half of this year. We're coming out of a very deep recession. We're coming out of a recession that is a result of a credit bubble bursting. And generally, when you come out of recessions where there's been issues in the credit markets, it takes a long time to dig yourself out of it.
I want to bring John Kanas into the conversation. John, it's one thing to look at the data and decide whether we are in a recession or perhaps slipping into a recession. What does it feel like to you? You deal with community-based companies. Does it feel to you like we're still in a recession or going into one?
It was hard to find the defining line between when we came out of the last recession and when we might go into another one, hopefully not. But frankly, I live in the world of a Main Street where we, as you said, deal with people who run their own businesses every day. And quite frankly, all of this economic data that's been coming up, combined with the fact that their family businesses and their medium-sized businesses continue to have little or no growth, is putting a lot of pressure on attitudes. And quite frankly, attitudes are pretty grim out there on Main Street right now. And it doesn't give one a great deal of optimism looking forward.
Optimism. How about confidence? Do you feel confident? Do your clients feel confident? The survey suggests that people out there are growing more gloomy, if anything.
Yeah, well, frankly, the combination of things that they're having to deal with, not the least of which is the very slow pace of growth in their own companies, is eroding their confidence and making it harder and harder, I think, to predict what's really going to happen.
Well, and I think for Main Street, when you have an unemployment rate at 9.1% and the peak was 10.1%, we're 2 years into recovery, you know, that's going to still feel like a recession to a lot of people. And we saw that in the most recent readings on consumer confidence, the lowest readings on confidence since the early 1980s, below the levels of confidence during the financial crisis, which is actually quite surprising.
So, Conrad, what do we need? More stimulus?
Well, it depends what type of stimulus. And right now, I think that policymakers are misfocused. Right now, it seems like there's some baby steps towards a second round of or a third round of quantitative easing. I'm not convinced that that's the direction that we're going to go in. I don't see how that helps. And also some of the policies that are being bandied about in the White House, you know, extending unemployment insurance benefits. I mean, these aren't the things that are going to get the economy going. I think there would a lot of people talk about businesses would like to see more clarity on the direction that Washington is going in. I think that would be helpful. But right now, I think that policymakers are focused on larger businesses. I think in the financial services industry, they're focused on larger banks. And that's really not what's going to give us a stronger growth rate. There has to be more of a focus on smaller businesses.
To Conrad's point, John, one of your fellow CEOs, a well-known one up here in New York, has made the case very publicly, in fact, to the chairman of the Federal Reserve, that we need less bank regulation if we want to get the economy going. Do you agree with him?
I think we need a proper level of bank regulation. Jamie Dimon, obviously. Look, Jamie was expressing the frustration that I think we all feel, and that is the Dodd-Frank regulations have yet to be written. And they are a sort of a blowback, if you will, from the downturn that we all experienced in the last couple of years. And many of us are fearful that the imposition of even a greater, heavier layer of regulation on top of what is existing today is going to make the sluggish performance of banks even more sluggish. Just the cost alone of compliance with these new regulations is eroding bank profitability, and it's why you're seeing this find its way into bank equity prices in the last couple of weeks.
Yeah.
Gentlemen, thank you both. Great to see you, John. We hope you come back soon. Conrad, also great to see you. Conrad DeQuadros of RDQ Economics and John Kanas, the CEO of BankUnited, here on the Inside Track.